Good evening and welcome to this session of the live learning classes conducted by the Board of Studies of the Institute of Chartered Accountants of India. Let us begin as usual with an invocation. Sahana bhavatu, sahano bhunaktu, saha viryam karvavahe, tejasvina vaditamastu, tejasvina vaditamastu, ma vidvishavahe, om shanti, shanti, shanti. Fantastic. Welcome to all. And before, we forget it, let me wish you all a very happy Diwali because we are right in the middle of the Diwali season. A lot of you have are confirming by, so we have, I don't want to, read everybody's name because today we have to complete the topic. The topic we have selected, today we have to complete. So I just don't have time for that. So don't mistake me, but excellent and welcome to all of you. Only two queries have come. One is Vishal Pandey with why this section does not, does not 43, does not apply to the. See, private companies in those days were given a lot of exemptions. Okay, private companies in those days were given a lot of exemptions. Now they have been removed. Here, they simply want just listen to me, Vishal. I'm not going to tell it one more time. Listen to me. If you don't accept, leave it. But this is the reason. They want private companies to have more flexibility in fixing the terms of issue. When they issue preference shares, they want more flexibility for private companies. Since private companies are anyway not having public holding or public offer, we are giving some freedom to private companies. Same logic for 47 also. Same logic. They want private companies to have more freedom in operating. With regard to voting rights, they want private companies to have more freedom. Okay. Got it? So that's all. There is no other reason. Otherwise, beyond that, I am unable to explain. Okay. We need to pass in a resolution before any issue of bonus shares. See, basically for issue of bonus shares, once again, we'll come to bonus shares. I will just go there quickly. So we finished all this, we are almost there. Rights we finished. Sweat equity. See, for issue of bonus shares, earlier there was no need for passing any resolution. Today, you can see here now in there ordinary resolution in general meeting based on the recommendation by board. So there is a need for passing of an ordinary resolution. So this is clearly mentioned here in section 63 read with the rules. And is there any limit on issue of rights and bonus shares out of reserves? The limit could be only the reserves now. Yeah, see, whatever reserves you have, you can fully convert it into bonus shares. Beyond the reserves, beyond the securities premium account, etc., you cannot issue bonus shares. For rights also, there is no limit as such. Whatever you think the market will take can be taken up. Thank you, Mr. Karthik, for no, definitely, Mr. Karthik, but I cannot share my email ID, mobile number on. Chancellor. No. As I told you, go to my LinkedIn. There you will find, you search for Srikanth Sridharan or Sridharan Srikanth, you will find. Then you come on LinkedIn, you will definitely connect. That is the only way I can do this. Please don't mistake me for not sharing in this and don't ask also. And today, no time, please. Let us not have any discussion other than topic. Also, from now on, I'm not going to take any more queries. I will not be reacting to queries now till I complete the topics fully. Till I complete the topic fully. Then, time permitting, I will take up queries. I will take up, I may take up one of my assignments which I have given, which I will be uploading later. And I will also, I have one or two questions in the Institute Board of Studies. I thought I will take it with you. Not the entire thing. Now, unlike what Srinivasan wanted, complete. If I start solving, there will be no time. That is for you to personally and privately solve. Moreover, the answers are given. It's not as if the answers are not given. Answers are given. One or two small issues, I just thought I would try. Now, we move to reduction of capital. What is reduction of capital? We saw cancellation. Do you remember? When we saw alteration of capital, we saw cancellation of capital. What was that? The authorized capital, to the extent it is not issued or allotted, to that extent can be reduced, can be cancelled. That is cancellation. Whereas reduction is where capital which has already been issued, subscribed, and paid up will be reduced. Means that amount will be written off. In a way, that is a loss for the shareholder because he gave 10 rupees. Now the company is saying these 10 rupee shares are no longer represented by assets. So we are now going to reduce the 10 rupee share from 10 rupees to 1 rupee. So 10 rupee share, they will reduce it to 1 rupee. So to that extent, that 9 rupees he gave would be out. Straight away gone. It is a loss of capital, capital loss for the shareholder. For the company, it is a reduction in the liability. But that savings, whatever they get now, will be only enough to adjust the accumulated losses. Okay. From the accounting perspective, you might have studied something called accounting for capital restructuring or accounting for capital reduction and things like that. So whenever a company is not doing well, whenever a company is making losses, the chances are it would have borrowed heavily. So after some time, the capital will not be represented by assets. Though share capital is there, assets will not be enough to pay. Only liabilities will be there, right? And those liabilities also will be huge. Against that, there will be losses. So heavy accumulated losses, assets will be depreciated, and or value would not be there. Heavy losses, capital is not represented by assets. Capital, see, on the liability side, capital is there. On the asset side, nothing. Except, see, there will be nothing because in the new way, the losses are going to be reduced from the reserves and surplus, which means reserves and surplus will be one huge negative. To that extent, the capital will not be represented. So when that is the case, when capital is not represented by assets, then capital may be reduced. Another possibility is there. That is, this is a reverse possibility where the company is doing so well, or maybe it has sold some capital asset and it has got huge gain. And that gain is now with the company in the form of money in the bank account. No, that is not needed because their company is running well. Beyond that, they have sold some land which is idle. They realized some cash, money. That money now they want to give it to people. So they're saying, hey, look here, we will return the capital in excess of want here. So our paid up capital is now 2.5 crores. We made good money. We got good gain. 50 lakhs, we got over and above our needs. Return of that amount is in excess of wants. So you please take it off. We will give you that 50 lakhs and we will reduce the capital so that the remaining amount is enough. We will proceed. So both possibilities are there, which is why normally I have an Excel spreadsheet. I hope I have it here. I'll check up if I can show you that. I used to show a working. Let us see if I have it with me. If so, I can show you. See, now this is the balance sheet. I will increase it slightly. I can also give you a view, which is full page view. See, this is the balance sheet of a company called Unfortunate Limited. Hmm? I will see if you can have a view here. No. Okay, hopefully you can see it. See, this is a classic example of a company called Unfortunate Limited. How a company will be called Unfortunate Limited? No, only for the purpose of example. So the share capital of Unfortunate Limited is 100. It has fixed assets worth 100, current assets worth 10, 110. Now there is an accumulated loss of 95. So 100 minus 95, 5. So the capital is only 5. Though we say 100. See, in the new way of representing the balance sheet, the accumulated loss cannot be shown on the asset side. It's a debit item, but it will be shown as a reduction. No reserves. Instead, you have negative accumulated loss. So 100 minus. So the owner's value is only 5 rupees. On the other hand, on the other hand, you have huge bank loan. You have huge bank loans. 70 bank loan plus 15, 95 plus creditors 20, 105. So 105 plus this 5, 110. So capital is not represented by assets. Tomorrow, if this company is wound up, what will happen? 105. Fixed assets and current assets may not give you 110. You will be lucky if they give you 105. So the creditors themselves will not be paid fully, which means the shareholders will get nothing. So this is a classic case where this capital is not represented by assets. So it is better to remove 100 and instead at least to put 5 there. So that if every shareholder is having some 10 rupees, they will all agree to reduction. And they'll say, my 10 rupee share is today worth only 50 paisa. 50 paisa, that's all. In case the company is wound up, I'll get only 50 paisa. They will agree to this. In fact, when that is happening, you will have to go to the creditors also. Obviously, because and tell them, boss, we cannot pay you. We kindly waive the interest, take a haircut. So all of you give us waiver, blah, blah. So the bank will say, look here, we will take a haircut. But how about you? You are having share capital 100 rupees. It is not represented by assets. Reduce your capital, then come to us. So that is when reduction of capital will happen in one example. Another example is Fortunate Limited. See how these buggers are really great. They've got 100 rupees share capital, 345 fixed assets, reserves is 200 rupees, and bank loan, etc. Now, even for the purpose of example, I'll give you this better. It will be easier for you to understand. This will be easier for you to understand. See, what has happened now? This company has sold some fixed assets and realized money, and that money is lying in the bank or FDs, 250. Now these guys are saying, hey, we do not need this money. Yeah. We will repay your original share capital. Ma. Take your 100 and go. Yeah. Take it and go. Or take your 100 plus another 100, 200 rupees because reserves is also there. We'll do a valuation. Take it and go. This is similar to buyback. Only difference is here, the entire 100 is being paid. You can't do that in buyback. If you go through this process, the entire 100 can be paid off. So 100 plus 100, 200 you pay off. With the remaining, obviously you can't make the share capital zero. Na? You can't make it zero, right? So they will make it so small, like 10 paisa. They'll pay 198 rupees 90 paisa they'll pay to them. That share capital 100 will become from 10 rupees, it will become 10 paisa. So 9 rupees 90 paisa would be paid. Only 10 paisa will be there. Okay. Why they are doing it? Because there is share capital is in excess of wants. The money is already there. So they will reduce it to 10. Here also the bank they will have to take the consent of the bank, because when the money goes out, to that extent, the bank cannot have money. But even assuming you pay this 200 to these guys and you reduce it to 10 paisa, okay, your reserves will come down. You will have fixed assets plus 150 rupees, 100 rupees, 50 rupees in the cash and 145 rupees. So totally 195. So 195 is more than enough to repay the creditors. Whatever is left out, the shareholders may still get some more money or nothing, but they've got their money. So I'm giving these two examples to help you understand how the law is structured. So share capital may be reduced under two circumstances: when capital is not represented by assets or where it is in excess of wants. Okay. In both these cases, the reduction is not permitted if the company is in arrears in the repayment of any deposits or the interest. So any company which has not repaid deposits, it will be in arrears. It cannot go for reduction. Where one question is coming, I'll quickly answer it. Where company forfeited share due to non-payment of called up amount, then it is reduction or cancellation. Neither. If Ankur Patel is aware of accounting knowledge, he will understand. Where is the reduction? Where is the cancellation? For a temporary period, I am reversing the share capital. For a temporary period, I am debiting share capital, but not permanently. Ankur, you have to concept. Since you asked the question, listen to me. And if you understood it, say, yes, I have understood. Because you are working on with a doubt. I am clarifying the doubt once and for all. In forfeiture of shares, there is no permanent removal of that share capital. It is only temporarily reversed because this guy is not paying, and then again it will be reissued. When it is reissued, again it will be credited. So it is neither reduction nor cancellation. Definitely it is not cancellation, Baba. It is already issued, subscribed, only not paid up. So since it's not fully paid up, what we are doing, whatever the donkey has paid, we take it and forfeited. Whatever he has not paid, we are reversing share capital fully. Then again we are finding a new donkey and issuing it. So again share capital will be credited. So there is no reduction or cancellation in forfeiture. Forfeiture is an independent activity happening for a different purpose. Where somebody has not paid the call, you forfeit their money already paid, you keep it, you reverse the share capital, keep it in reversal temporarily. Note my voice, note my words. Temporarily. Ankur, that is the more important thing. Temporarily. And then once we reissue it, we again credit share capital. Whereas if you want to reduce capital, it will be permanently. Thereafter, share capital will never be credited again. Whereas in forfeiture entry, you will debit and then again credit. Ankur Patel, just for my own sake, since I am answering your question very sincerely, confirm that you have understood what I said. Okay. No, your awareness is good because there are only very few circumstances when share capital account will be debited. One of those circumstances is forfeiture, but it is only debited temporarily. Whereas in reduction of capital, buyback, winding up and all, share capital will be permanently debited. That's the end of story. In winding up, that is the end of the company also. That is the very last entry we will pass. The last entry will be share capital account debtor to equity shareholders account. Then reverse, bank, finally, equity shareholders account debtor to bank. That's all, balance sheet 0. That is the last entry we'll make. Okay, don't worry. Now, this is when capital will be reduced, correct? When capital will be reduced. Now, how capital? You can do that in many ways. One is by extinguishing or reducing the liability on any of its shares in respect of the shares not paid up. In the case of Fortunate Limited, what happened was fully paid shares. So I paid it back. Suppose it had been partly paid shares. Let us say that there was 5 rupees due. I will tell those buggers, hey, you don't have to pay that $5, ma. I already have enough money. Don't bother. I will extinguish that liability. Or you can either with or without extinguishing, cancel any paid up share capital, which is lost or is unrepresented by assets. See, our friends, the MCA, will wantedly do things like this. I very carefully explained to you, very sincerely said, cancellation is different from reduction. Now they are using the word cancellation. Though they are using the word cancellation, they actually mean only reduction. Because only paid up capital will be reduced. Authorized capital will be cancelled. Understand it? You will never have any doubt. Whatever MCA may do, principle-wise, you will be clear. Only authorized capital, which is not yet issued, can be cancelled. Whereas only paid up capital, which is issued, subscribed, and paid up, can be cancelled, reduced. So by cancelling or reducing any paid up share capital which is lost or is unrepresented by available assets. We saw that, na? Unfortunate limited. Pay off any paid up share capital which is in excess of wants. We saw fortunate limited. Na? For unfortunate and fortunate. Both are two examples. Writing off liability could be fortunate limited, where instead of fully paid up, suppose I had partly paid up shares, I can say to the extent you have not paid up, you are relieved, don't have to pay. So I'll reduce that liability totally and make it fully paid up. Those shares can become fully paid up. Okay. Thank you, Ankur, for confirming. Now, so whatever may be the method, at the end of this exercise, capital will be appearing in the balance sheet at a reduced figure. So in any example, capital will not be 100. It will be reduced, means 10 rupees like that. Because 10 rupee share is now going to become 0.10, right? Not even 1 rupee. So it will be shown 100 rupees will become 1 rupee in the share cap, in the balance. Okay. So for this, you have to alter the memorandum by reducing the share capital or the number of. So authorized capital also will have to be removed. Book entries are passed. Balance sheet is changed. Everything. For this, what are the requirements? You have to pass a special resolution. And you have to go to the tribunal and get confirmation, because tribunal is involved here because you are doing something that is going to permanently change your capital structure. So everybody's interest should be considered by the tribunal. Therefore, tribunal will take up the matter. It will take a little time. It will take easily 1 year also. Sometimes it will take, because tribunal works very slowly. Then tribunal will give notice to all these people, central government, that is MCA and other central government ministries, if they have anything to say. Registrar, the ROC himself will have option. SEBI, in case of listed companies, SEBI will come to protect the investors. Finally, the creditors themselves will be given specific notice saying the list of creditors will be finalized and specific notice will go by email or registered post to each one of them, clearly saying this company is going to reduce its capital. Afterwards, the liability will be only so much, or whatever they paid is going to be fully written off. If you are if you have any objection, please inform immediately. So this will be done, right? Then notice will be given by the tribunal to stakeholder. Stakeholder means not necessarily only the creditors and shareholders. Stakeholder is a wider term. It will be in public domain. So investor associations can object. Consumer associations can object. Workers' unions can object. They are all stakeholders. Even activists. You know, there are a lot of NGOs which are into activism. They can also object. So, yeah. Tribunal means NCL. From now on, whenever I use the word tribunal, please remember I am using only NCLT. Please, for removal of doubt, whenever it is there in the definition also. Very clearly in the definition it says tribunal means the National Company Law Tribunal. Okay. So whenever we say tribunal, we do not mean ITAT, Income Tax Appellate Tribunal, or FEMA Appellate Tribunal, Foreign Exchange Appellate Tribunal. There are so many appellate tribunals. Here we and tribunals. Here we mean National Company Law Tribunal, popularly known as NCLT. Okay. Right. Now, if any stakeholder wants to make representations saying this cannot be done or this will prejudice us, whatever, they have to send their representations within 3 months of date of receipt. If no representation is received, then there is a presumption that nobody has any objection. Any representation is received, then they will be called for a hearing. Finally, the tribunal will take into account. See, ultimately, it's the tribunal's decision. So now the tribunal is satisfied that the debt or claim of every creditor has been discharged. So if creditors have given their NOC, ideally what you should go to all the creditors. Tell them. See, because already you will be engaged with them now. Obviously, if it is unfortunate limited, there will be misfortune limited or whatever, fortune, unfortunate limited. The creditors already will be on the neck, and you will be fighting with them and telling, take a haircut, take a shave, whatever you'll be telling. So all this hair arrangements will be happening. Now, while doing that, they will be saying, hey, you go around, reduce your capital. So they will have no objection. Still, you have to take an NOC from all of them, say, we have no objection. If any creditor says, I am not going to give you NOC, then you have to discharge him. Or you have to determine, means you have to give some sort of a commitment to him in some way to satisfy him. Or you have to tell him, boss, I can't pay you the full amount. Take portion and go and give me a clean check. Whatever you do it. Or you have to secure him. Secure means to tell him, I don't have money to pay, but my property is there. To the extent that there is a first charge holder is there, I will make you second charge holder. Whatever. So the value of the property is enough to cover both of you. Creditor is happy, he is happy. Whatever it is, finally consent also. If nothing, you have to get the consent from him. Okay. So creditors are to be either discharged or determined, meaning lower amount is to be paid, something has to be done, or secured, or consent has been obtained. See, in the case of Fortunate Limited, creditors will have no objection in giving no objection because they will be properly serviced. Everything is coming correctly, no problem. Okay. Before making an order confirming the reduction of capital upon such terms and conditions as it deems fit, one of the main purposes of Section 66 is to protect the creditors so that the company cannot quietly reduce the liability and run away of the shareholders. So the creditors have a very important role to play in reduction of capital. See, if preference shareholders are there, even they have a right to object. So they are also going to be there. They can also come and say, no, we can't do it like that. One more thing, if you remember your voting rights of preference shareholders, there we might have seen preference shareholders normally, if preference dividend is correctly being paid, cannot vote other than those matters where they are interested. One of the matters in which they are interested is reduction of capital. We saw that when we saw. One of the matters where they are interested would be reduction of capital. If the equity holders are reducing their liability or reducing their amount quietly, the preference shareholders are affected. So they also have a right to say. They will be called for the meeting itself, where their votes also will be counted at the time of special resolution. Okay. Tribunal should not sanction any application for reduction of share capital unless the accounting treatment proposed by the company for such reduction is in conformity with the accounting standards specified in Section 133. See, okay, where discontinued operations, everything, you have to completely ensure that accounting standards are complied with. And the company's auditor has to give a certificate to that effect. Okay. Nancy Saxena, I think your knowledge is very, very rudimentary or very, very primary. So you need to do some kind of a bridge study. Means creditors is a bigger term, no ma'am. Are you familiar with accounting? On the liability side, you have non-current and current liabilities. No? That entire thing could be creditors. Debenture is only one type of liability, creditors. Only one type. You have secured creditors, you have bank, you have trade creditors. They are also liability creditors only. Am I correct? So you have some depositors are there. Unsecured creditors could be there. All are creditors. So the term creditor is a big term. In that big set, universal, there is subset is called debentures. Debenture is only one type where the company issue debentures. Okay. So creditor does not automatically mean only debentures. So your statement is wrong. Please learn and try to widen your general knowledge of accounting and finance. We shall presume that if you're doing intermediate, you have completed BCom or CPT. So certain things should have been learned in CPT or BCom. That level knowledge is expected when you come here. Okay. So I cannot keep answering questions like this. Am I correct? I'm making this point because time is very less. So you may have to write this down somewhere and look it up from some other source rather than take it from me when I am covering something at a higher level of knowledge. Okay. Similarly, buyback will be taught by me very shortly. That is why I'm not reacting to your comment. It's the next section I'm going to deal with is buyback. So 67, 68 is buyback. At that time, I'll tell you in detail about buyback. Don't worry. Okay. So, next, moving on. The order of the tribunal confirming the deduction should be published by the company in such manner as the tribunal may direct. Like public notice should be given. That the tribunal will tell you how to do it. Okay. Whether to put it up in the website or whether to give an advertisement, whatever. And also that order should be delivered to the registrar for registration within 30 days of receipt of order together with a minute. Minute means noting. Minute means noting. The noting should be given. A noting about the matter. So memorandum you can say. Approved by the tribunal showing the amount of share capital, the number of shares into which it is divided, the amount of each share, and the amount, if any, at the date of registration deemed to be paid up on each share. So this is post-deduction. What will be the amount of share capital, the number of shares into which it is to be divided, then the amount of each share. So what did we do? We took 10 rupee share and we made it 10 paisa. So now we have to say the share capital will be 1 lakh divided into whatever 100 shares or whatever of 10 paisa each. And the amount, if any, at the date of registration deemed to be paid up on each share. Okay. So this will be also told. So this will be after the deduction. Please understand. This will be after the deduction. Okay. The registrar shall register the same and issue a certificate to that effect. With that, the reduction will get on. Now, suppose at the time of proceedings before the tribunal, okay, at the time of proceedings before the tribunal, 1 or 2 creditors got left out, intentionally or unintentionally. But so before we go there, what will be the provision for them? Before that, please understand the principle. The consequent of reduction of capital is reduction of a member's liability, if any, to contribute towards the debt in the event of winding up. Please, friends, concentrate. This will be relevant only for partly paid shares. See, if it is a fully paid up share and it is reduced, it is a loss for the equity shareholder also. But if it is a partly paid share and the liability is reduced, then it will be a gain for the member, but could be a loss for the creditor. Because earlier, on a 10 rupee share, 5 rupees was paid up. Balance 5 rupees was available to the creditor. Because in case of winding up, that 5 rupees could have been called up by the liquidator and would have been paid, and it would have been used for paying the creditor. If you wipe off that liability, the creditor will lose his, that amount, na? That possibility of getting that 5 rupees. Na? So, a creditor who is entitled to object, because obviously, I want you to understand why creditors will have the right to object, because this will be there only for partly paid shares. Fully paid shares, what is the loss for the creditor? Only loss for the equity shareholder, because he had 10 rupees. That entire 10 rupees was lost or became 10 paisa. But if it is partly paid share and liability is being written off, then creditors will lose, because though it is not appearing in the balance sheet, it is a contingent asset for him. Please understand. You can understand contingent liability now, meaning it will be incurred on the occurrence of an event. Like that, this contingent asset will be available to the creditor in case of winding up. When winding up commences, what will happen? The liquidator will call up the balance amount of 5 rupees. So till such time, it's a contingent asset for them. That asset is not going to go away. So every creditor has a right to object, and you have to prepare a list. Now, a creditor who is entitled to object may find that his debt or claim was not entered in the list of creditors. Maybe due to ignorance or whatever. May not be intentional or intentional. This is due to him at the time of reduction, he was not aware of it. Ignorance of the proceedings. Or he may be aware, but he may not have been aware of the effect. So even if his name is not there, he says, "What is there? Let us be." But later on, after the reduction, After the reduction, the company defaults in settling its debtor claim. See, after the reduction, if the company pays him, no problem. But the company does not pay him. Now, what can he do? Then, please note, very important. Every member, as on the date of registration of tribunal's order, see, within 30 days, you file it to the registrar now, and the registrar registers now. So, every member who was, as on the date of registration of tribunal's order, shall be liable to contribute according to the liability to contribute on that day. So, whatever asset was available on that day for him, that contingent asset will be available, provided the company defaults. If the company pays, no problem. But if the company defaults, then though the liability is written off, still every member who was there on that day will have to contribute according to his liability. If there are any, can you come again, Parth? Are you asking if there are any cases where creditor's name was not included? I'm not aware. Maybe if you search in the company cases, you might find I am not aware of anything where creditor's name was left out. Usually, we will get consent from all the creditors. Here, only provision has been made for such a contingency, for such a possibility. I am not aware of any practical case where creditor's name has been left out. No, I have not seen anything. Nor in company cases, I have come across any case where creditor's name was left out and then he went. Never. Because, see, this will be only if there is a default in settling his claim. So, my knowledge, no. But this is there as a precaution. In case it happens, this will ask. No, because it is there, no company will want to do this. Even if they remove his name from the list, tomorrow he can come and claim. Members will have to claim. So, nobody will agree to it. So, the learning I am getting out of this is, if I were finalizing a reduction of capital work for a client or for a company where I'm CFO, I will be extra careful in finalizing the list of creditors for reduction. See to it that the correct and complete list is prepared and notice is sent to all of them. And you take a disclosure from an NOC from all of them or settle them or whatever. Then there should not be any problem. Now, every member as on the date of registration shall be liable to contribute according to the liability to contribute on that day. Okay, so this is, so the above provision shall not affect the rights of the contributories inter se. That is, amongst themselves, the liabilities of the contributory, whatever one contributory settles, the other can claim. If I am claiming for everybody, so I am paying for everybody, I can claim from the others. Okay, that right will not be affected. Let us say that there are 5 people to pay. I want to finish this matter, so I pay on behalf of all of them. Then I can collect from the others. Now, that right will not be affected. Right? Nothing in this section shall apply to buyback of its own securities by a company under Section 68. Nothing in this section shall apply to buyback of its own securities. Now, please understand, 66 is a section that is, 66 is a section that is universal. If a company wants to reduce its capital, it has to comply with Section 66. Whatever may be the reason, you go through the format of Section 66. But one exception has been created. One exception. You can reduce your paid up capital without going through the formality of 66. I'm repeating. You can reduce your paid up capital without going through the formality of 66. No tribunal, no creditor, nothing. Provided you go through Section 68. So to answer Nancy Saxona's question, buyback is a special method of reduction of capital, which is given in Section 68. Where if you go through the procedure for buyback, as the name implies, buyback means taking it back, buying it back. So you buy back. Okay. Now, buyback of its own securities by a company under Section 68, if you're going through it, then 66 will not apply. So when you comply with 68 relating to buyback, don't worry about 66. So 68 is an exception to 66. Nothing in this section will apply to buyback of security in accordance with section 68. That's all. So what is that buyback? Baba, I will teach you 68. Just give me 2 minutes, I will teach you. Okay. Debenture reduced or not? How can debentures be reduced? Debentures are redeemed. They are secured creditors or unsecured creditors. They are redeemed. You repay. See, debentures are borrowings. So how they can be reduced? They will be repaid, redeemed. Suppose you don't redeem, then he is a creditor. He will go to court and the court will order you to pay. Or else you have to go for restructuring. See, at the time he will become one more creditor with whom you will have a restructuring. So reduced. Okay, I don't know if the spelling mistakes are due to typographical, but reduced has a CED. REDU, CED is the correct spelling of reduced. Okay. At the time of loss, can company reduce, not reduced? At the time, sorry, the problem is I have to correct English. I'm so sorry. At the time of loss, can company reduce? No D. Debenture amount. No, sir, you cannot reduce debenture. Sir, simple, Mr. Mohammed Sohail. I have borrowed from you 1 lakh rupees. Instead of entering into an agreement with you for loan agreement, I enter into a debenture trust deed and I create a debenture instrument and I give it to you. Should I pay you 1 lakh or can I reduce 1 lakh? You'll kill me, na. When it is your own money, you won't kill, na. The debenture holders are all fools. They will agree to reduction. No. You have to redeem them. Suppose you don't redeem, then they will go to court and collect it, demand it. Okay. Is there any profit? How for who? For the company, there will be a profit. In a way, there will be a credit entry. Okay. See, for the company, it will be a benefit only. Which is why, if you have learned capital reduction and restructuring, accounting for restructuring, you would have credited an account called capital reduction account. The accounting entry you would pass is share capital account debtor to capital reduction account. That capital reduction account is a credit balance. It is like a capital profit. You will pool all these benefits into it and then use it to reverse the losses. So debit capital reduction to P&L account negative balance, all that, two preliminary expenses, all that you do. If you work out a problem in accounting, you will understand this. Okay. At the time, remember, it has a link to section 66. There will be no profit. There will be a slight credit. That credit will be... Anyway, remember, these are all cases where already there are heavy losses, because of which the capital has been fully eroded. You are only bringing it to reality. That's all. You are creating reality check and bringing it. Instead of showing the capital at that high amount, you are reducing it. So there will be no real profit, but there will be a credit entry, which will... See, when I'm debiting share capital, I have to credit some account now. So I will credit an account called capital reduction account, which is in the nature of a capital income. Then I will use that credit balance to write off the losses, so that at the end of the exercise, my balance sheet will look clean. The accumulated losses will go. Capital will be reduced. Creditors will take a haircut and come. So my company will become manageable. Now for next 5 years, if I work hard, I can pay off the creditors, again build value and bring back my company, revival. So usually reduction of capital will happen only where the company is not doing well, is the point. Okay. Yes, that is the point of the exercise part. Even if their liability is reduced. See, Baba paid up. Yo, Partha, you are again forgetting the point I am making. See, this provision will apply only to partly paid shares. So for partly paid shares, their paid up capital will not be reduced. For partly paid shares, see, if it is fully paid or partly paid shares, if the capital is reduced, this provision itself is not relevant, because he was supposed to pay 10 rupees, he paid you 10 rupees, then you reduced it. Where is the liability? So this provision for creditors left out will not apply to fully paid up or partly paid shares to the extent of paid up amount. It will apply only to the extent of partly paid shares to the extent of paid amount. That liability, if it is reduced and the creditor is left out and there is a default, then those people who are there on that day will have to contribute irrespective of the reduction. Only partly paid up. I think I've explained it very clearly to you, Parth. And that is why beginning itself, I kept on saying only for partly paid shares. So to the extent of the reduction in liability happening due to reduction, they will be still liable, provided if there is a default in settling that excluded creditors liable. Okay. Now, why I'm getting a little excited? Now, you people are very poor in listening. See, when I'm talking now, you are not listening. You are thinking of questions to ask. It's a very dangerous attitude in a student. First, a student should be like a sponge or an open, bowl where you should take everything and understand it. Such a student rarely has questions. Such a student, rarely has questions and if that student has a question, it will be something that will be over and above what was taught. Such students, I have had such questions from you. Very, very intelligently you'll ask, sir, how about this? Oh, yeah, in that case, this is what happened. Maybe, sir, you have covered up to now. What about this? Uncovered portion only they will. Whereas on the covered portion, when the student is listening and concentrating and has some knowledge. See, a student who has no knowledge of accounting, basic corporate accounting, now how can he or she understand this? So you are up to +2 and even your BCom knowledge. Okay, BCom, I don't know, CPT knowledge, some knowledge is needed here. And this is linked. See, these topics, buyback and all, are closely linked to your accounting. So you would be working out problems in accounting on the same topics. Some of you might be very expert in that. For you, this should not be great because the same rule only is going to come here also. Am I correct? Now, see, we saw the liability of a shareholder. Now, how about the liability of an employee? Officer. Officer includes director, key managerial personnel officer. Any officer of the company, if they knowingly conceal the name of a creditor who is entitled to object, or knowingly misrepresents the nature or amount of the debt or claim, means knowingly reduces it, or abets. Abets means supports. See, somebody else is doing it. Let us say that MD is doing it. The CFO is helping him, abetting, supporting, or is privy. Privy means aware of. He is privy, aware of such concealment. So even being aware is enough. You are a CFO, a member of the Institute of Chartered Accountants of India, responsible professional. You are aware that this has happened. You are privy to that concealment or misrepresentation, and you are keeping quiet. Then that also is called connivance. Connivance. When I am aware of something wrong happening and I keep quiet, I become Gandhiji's monkey. Gandhiji's famous monkeys, na? One monkey will do like this, one monkey will do like this, one monkey will do like this. Okay, close the ear, eye, and mouth. Gandhiji's monkey. So for that convenience, they will become Gandhiji's monkey. No. And Gandhiji told that monkey, kept that monkey is to say, listen to only good things, so don't listen to bad things. See only good things, don't see bad things. Speak only good things, don't speak bad things. That was why. But most of us are very clear. Let me not see. I'm aware, but I will act as if I'm not aware. Like that. Become conveniently blind. So such cases, that officer will be liable. Okay. For payment. He will be liable under section 447. Do you know our good old 447? 10 lakh, 5 lakh, 7 years, etc., etc. Now we go to 77. See, 66 is procedure for reduction. Now, 67 is a company purchasing its own shares. They are not saying you cannot purchase. They are not saying you cannot purchase. What are they saying? No company shall have the power to purchase its own shares unless the consequent reduction in capital is effected in accordance with this act. See, my dear friends, you are all experts in accounting. Just think 2 minutes. Company buys its own shares. What will happen? So it has money in the bank. It goes to the market. purchases its own shares from the market. Maybe the market price is going very low. They find an advantage. The intrinsic value of the share is more than the market value. Market is foolishly reduce it to low price. It's a great opportunity. Let me buy the share. You will buy the share, no? When you buy the share, this is actually possible in buyback also. When you buy the share in the market, what entry you will pass in your books? You will put investments account data to bank. Investments account data to bank. So that non-current investment or whatever will be appearing on the asset side. Under non-current assets, it will come as non-current investments. Investment in our own company share. Let us say 1 crore. Now, how is it reflected in the liability side? This 1 crore is represented by paid up capital and share reserves. Yeah. So to this extent, to the extent of these shares, our own shares, that paid up capital is not represented by real assets now. Friend, suppose the company goes into winding up, it looks very foolish. Now, see, the company will be its own member. Who will pay it? So net effect is what? On the asset side, I'm having 1 crore. And the liability side, I have paid up capital and free reserves. Now, write off, cancel, set off. That's all. Asset side, I'm having, and showing this as, if I show this as asset, then to that extent, the liability is not represented by real assets now. But it's something like simple, ma. I'll put it this way. It is something like putting Rajesh capital account on the liability side, you put Rajesh. On the right hand side, you say Rajesh loan account, as if you given loan to Rajesh. You understand? Now, hey, this side I owe Rajesh, that side I have to get from him. So set up both the entries. Yeah. This side I owe that creditor, and with this side I owe the shareholder. On the other side, I am the shareholder. Foolish, na? So the law says, come on, if such situation arises, go ahead and buy, but go through the process of reduction in capital. So this is the point. Now, friends, this is stupid because no company will go through 67 mark. The reason is, if you want to purchase your own shares under 67, you have to go for reduction 66. That will take 1 year, Bahas. It will take 1 year. After you get the approval, only you can buy. Now, the opportunity to buy will be a small window. See, when there's a total collapse in the market due to some extraneous reasons, some good blue chip companies will be trading in the market at a price which is far below their intrinsic value. See, intrinsic value is the real fair value of a company's share, the real fair market value. Whereas the market price of the share is what the market perceives. So today, for example, I'll just give an example, try to understand, nothing to do with reduction. The name of the company I'm going to tell did not go through reduction. I'm giving as an example. If you can understand, I'll be happy. See, in 2009, Maruti Suzuki or Maruti Suzuki Limited, Maruti Industries, they were not doing well. And they were slowly losing their market share also because of other private car players coming in. From a 56% market share, they had slipped down to 52%. Also, their Manesar plant was having heavy problem, etc. So, there was a huge, shall we say, negative opinion about Maruti. So, the share price fell and came as low as 900, as low as 900. Now, at that time, I did an analysis of the balance sheet of Maruti. I took the last 10 years balance sheet. I projected it to the future. I presumed that Maruti will lose further market share, which is what happened. It lost further market share. I bought it right down to 45% market share. Based on that, I did projection of income, etc., etc., etc. Then I applied discounting and I found out the intrinsic value of Maruti Industries in 2009. When in the market it was being quoted at 900, I found Maruti was capable. At that time, my valuation came to 3,000. My valuation came to 3,000. That is the real value of Maruti. So I started buying at that time. 1,200 rupees I bought. 900. By the time I could decided to buy now, price has gone up to 1,200 because many people have done the same analysis and are finding that, hey, Maruti is a good buy at this price. Buy it. So they started. So automatically when the slight demand comes, it's going up. But still, there's a lot of negative. So there's no buying pressure, but still buyers are there. So I went rapidly into the market and started accumulating. Not much, 100 or 200 shares I bought and kept it. The point I'm trying to make is that day, market price is 900. I am arriving at an intrinsic value of 3,000. This concept is very important for you to understand. Market is cannot be the only method of determining value. There are other valuation methods also which you will learn when you come to either final or intermediate finance. You will learn method like the method I used called intrinsic valuation is one method. Of course, relative valuations are also there. I'm not going there. All I'm trying to say is intrinsic valuation I use and I find values. Now, if the Maruti company had done the same thing, now they will realize, hey, this foolish market is giving 900 bucks. My share is definitely worth 3,000. Now is the time to buy it. And now is the time to close that liability to that extent. If such an intelligent CFO was there, he would have done it. Because today, Maruti's price, you know very well what it is. It is 10,300 rupees. 10,300. It went on to 4,000, 5,000, 6,000, then 9,000. In fact, when it fell again to 6,000, it came right down to 4,000. Again, I purchased it because when I did a evaluation of Maruti at 4,000 market price, my evaluation came to 7,500 again. So, and with an improved position, not what it was at that time. Anyway, point I tried to make, my dear friends, again and again, is there could be a gap between the market price and the real value. If the market price is lower, it is an opportunity for buyback. Now, suppose the company wants to use this opportunity and purchase its own shares, the window is very small. So we do not have the time to go to tribunal to do all these things. Therefore, as a via media solution, they have given 68. They said you can, if you find such an opportunity, buy back your own shares. Go through 68. Like that. Okay. So there again, you can go through it and you can do it. So usually people will not go through 66. They would prefer to use the convenient route of buyback. Right? Now, suppose some other company is there which is listed on a stock exchange. They want to get themselves delisted. Then they have to buy back all their shares. They have to go to tribunal, get permission, do it. Or go year by year, you go small, you take it up. Okay. When you come to buyback, you will understand reduction capital is affected. That means you go to the tribunal and get the confirmation. Now, company may not want to go through the long-winded process. If you don't want to go through, easy method is there called buyback. If you go through 68 buyback method, then you don't have to go through tribunal and all. Straight away, you can go on your own and buy. Now, somebody may have a brilliant idea. They might say, hey, you are saying I cannot purchase my own shares. No, I am the MD of the company. I will take loan from the company and I will purchase the share. See, same logic. Hey, my company share is no quoting in the market at 300. I have done my own valuation and I find minimum my company is worth 1,000 rupees. 300 rupees it is quoting in the market. Hey, wonderful opportunity to buy. But I don't have money. So can I borrow from the company and buy the share? No. No public company. Please note, only public company. Private can. No public company shall give financial assistance for the purpose of or in connection with purchase or subscription of or for shares in the company. So, no public company can give you a loan. Financial assistance means loan for the purpose of or in connection with purchase or subscription of or for shares in the company. So, you cannot borrow money and invest in that company. You can't borrow money from that company to invest in that company. This cannot be done whether directly or indirectly. Okay? Whether by means of loan, guarantee, provision of security, or otherwise. That's all. Means the company cannot give a loan to Mr. X, who will give a loan to the MD. No, even that route is covered. Everything is covered. Okay. Idea is to prevent using the company's funds for purchase its own shares through others. Okay. Thereby violating section 67. Exceptions. Lending money by a banking company in the ordinary course of its business. Lending of money by a banking company in the ordinary course of its business. I'll give a simple example. A bank may lend money on the security of shares. Okay, so Mr. A is a businessman. He is borrowing money from the bank. He goes to the bank and says, "Look here, I don't have any assets. I don't have any physical assets, no land, no building, nothing. But I have huge portfolio of 4 crores investment in shares. Please value it." Today, the value that portfolio, my portfolio is worth 4 crores. Not my portfolio. That is okay. That is also maybe worth 4 crores, but my portfolio is worth 4 crores. You take it and give me a loan of 2 crores. So bank says, okay, we will give. Looks good. You pledge it. You mark a lien in the depository account so that in the DP account, it will be said lien mark. So that those shares cannot be sold unless the lien is lifted. And the bank will not lift the lien unless the amount is repaid. So this is normally course of business. Banks lend money on this. Now, suppose Mr. X is holding shares in that company. One of the line items in that portfolio list, one of the line items in the list of shares owned by X is this bank. No problem. Because lending of money by a banking company in the ordinary course of business exempted. This will not amount to funding of the bank for purchasing its own shares. I'm giving an example to help you understand. Okay. Now, Mr. Rama, I'm going to answer your question when I come to buyback. It is a good question, but when we come to buyback, you may not want to ask that question itself. The question will be answered. Okay. Funding of purchase or acquisition of shares to be held by employees or trustees for the benefit of employees. So, you can give a loan for purchase of shares to be held by employees or trustee for the benefit of employees in accordance with the scheme approved by a special resolution. So you can lend money provided the idea is that trust will get income. And that money of the trust will be used, income of the trust will be used for the benefit of employees. Means their children may be given a scholarship, some medical assistance, something. So that such cases where there's a scheme, you can fund the purchase of or acquisition of shares by employee to be held by employees. Also, sometimes you might fund them when they don't have money to buy the ESOP, they don't have money to buy the options. Then you can fund them and they can buy it. Then later on they can repay it back to you. Provided it is to be held by employees. No other person you can do. Or you can give loan for funding of purchase or acquisition of shares by persons in the employment of the company. In the employment of the company. So this is again employees. So you're directly giving a loan to the employee for purchase of shares. Other than directors or key managerial personnel, you cannot give fund for purchase of acquisition of shares to directors who are employees or CFO, company secretary. No. Only other than directors or key MP, you can give a loan for buying shares. But the limit is up to 6 months salary. That loan cannot be more than 6 months salary. Okay. Again, note it. Redemption of preference shares, what all we are talking about is only for equity. Redemption of preference shares is not covered by this. Nothing in this section shall affect the right of a company to redeem any preference shares. See, whenever you're talking about preference shares, never use the word buyback, reduction and all. Preference shares are redeemed. Got it? Preference shares can either be redeemed or converted. That's all. Whereas only equity shares can be reduced or buyback. Please don't. Similarly, debentures cannot be bought back. Debentures cannot be reduced. Debentures can only be redeemed. That's all. Or converted if they are convertible. So please do not use the word reduction in connection with the preference shares redemption is not covered by section 67. Okay. It is not covered by 66 also. When you redeem preference shares, you don't have to go through 66 because already there is a section for redemption now. You will go through that section, right? So again, you need not comply with 66. Okay. In case there is any default, in case without going through the reduction process, you buy back or you purchase your own shares or you fund the purchase, then company will pay 1 lakh up to 25, fine 1 lakh up to 25 lakhs. Up to is not included here, but please read that word up to there. It is given in the Board of Studies material. That small dash is up to 1 lakh up to rupees 25 lakhs, and imprisonment up to 3 years. Up to means maximum 3 years. The court may have a concession and say, we will give you some exempt. Okay, I'll go for 1 year, 6 months. But maximum they can give only 3 years. Beyond 3 years, even the court cannot imprison you. Now we come to buyback of securities. Section 68. No, boss, 67C excludes directors KMP. So directors and KMPs, you cannot fund up to 6 months or not. Employees, if you're funding, there is a limit. This sentence is very clear, ma. Funding of purchase by persons in the employment of the company other than directors or KMP up to 6 months. So within bracket, when I put something, na, that is associated with only employees. Okay. So that, got it? So good. It's a good question, Nagaraju. So this is applicable only to non-director, non-KMP employees who can be funded for purchase or acquisition of shares up to 6 months of their salary. I hope you have clarified. Now we move on to buyback of securities. Now, buyback, you might have studied it in accountancy also. When you were working out problems, you might have done it. At the time, the faculty who taught the accounting entries by force would have had to teach a little company law also to you. Okay, am I correct? He would have taught some of the 68 also to you, because the accounting treatment for buyback has to follow the rules of law. That is why corporate accounting and corporate law, especially share capital and debentures topic, it's very closely linked. Okay. Also managerial remuneration. Later on, when you come to self-paced learning in final, you will see that. You'll have to read. So, Section 68 is an enabling section permitting a company to purchase its own shares subject to certain conditions. So, 66 is a long-winded procedure. 67 says you can purchase provided you go to 66. Now, I am a company CFO. I see a huge opportunity here. I see my company shares are being quoted at a price, traded at a price which is far below their intrinsic value. If you are an intelligent CFO, what you will do? You will run to your board of directors, MD, and say, sir, opportunity, what? We can purchase. No, you only told 66, you can't buy back a tribunal. No, Baba, I am not interested. No, sir, forget 66, sir. Forget 67. 68, hai na? What is this 68, man? You tell me. So 68 is an enabling section, sir, where you are permitted to purchase without going to tribunal, etc., provided you comply with certain conditions. So your MD who does like this and says, sits back and says, drinks a cup of glass and says, okay, now tell me, what is the procedure? So that, most corporate executives are bored with chartered accountants and company secretaries because we take a lot of time to explain the simplest things. And so he knows this is going to take a lot of time before the chartered accountant can come out with a clear answer. So my humble suggestion, don't be like that. Learn how to express things in short and sweet way. Okay. So, in fact, when I'm at home, my wife keeps on telling me to kiss. What is kiss? No, don't get worried. Kiss means keep it short and simple. Keep it short and simple. Don't use long-winded language. So, in simple words, you tell your MD, sir, first of all, there should be authorization in our article. Okay. Friends, as usual, the devil of internet connection has created a problem. So, continuing. So, up to 10% or less of paid up capital plus free reserves. So, what you do, you go to the balance sheet, you see what is the paid up capital. Friends, paid up capital includes preference capital also. Okay. Please, if you have a notebook or something notes there, write down in bold letters somewhere you write so that you will never ever forget it. Paid up capital includes paid up preference capital also. Because sitting in the exam hall, they'll give you a problem with balance sheet. Problem on buyback of securities, they will give you problem with balance sheet numbers or extract from balance sheet. There you'll find equity share capital, preference share capital. So you'll have a doubt. Preference capital, should I take or not? Like that. Don't have that doubt. Equity capital plus preference capital equal to paid up capital. Free reserves, please be careful. Only those reserves which are available for declaring dividend. So P&L account hai, general reserve, dividend equalization reserve, capital redemption reserve. No, it is not available for declaring dividend. You got it? Revaluation reserve. No. Okay. SEZ rehabilitation reserve. No, because that is a specifically earmarked reserve, not available for declaring dividend like that. So these cases you have to be very clear. So then you have to calculate what is paid up capital and free reserve. Then calculate 10% of it. Up to that amount, you can buy back the company's shares without any shareholder approval. Just board resolution enough. Can you see why they have given this facility? Because I told you, the window of opportunity may be very less than that. See, I gave an extreme example where Maruti was quoting at 1,200, whereas its intrinsic value was 3,000. That was because Maruti had been hit extraordinarily by the thing. Now, during pandemic, there was a huge opportunity for IT industry. I tell you, Infosys was undervalued. During pandemic, I was offering a course at the Bharatidasan Institute of Management on business valuation, where my students, I make them do valuation. I actually make them do the valuation in workshop mode. So every class they will do presentation. So one team, they did Infosys, and they came out with the discovery, sir, Infosys is quoting below its intrinsic value. They came out to 1,200 or something when it was 900. See, the window is very less. Are you able to understand? It's not a huge gap. It's 900 to 1,200. If 10 more intelligent valuation experts in the country decide, they will realize this, they will fill the gap, they will buy it. So you have to work very fast to buy that share. So what I told them was, in case because I had also done a valuation of Infosys, not only Infosys, all IT companies were undervalued during pandemic. All IT, but the gap was very, very less. The gap was very, very less, which meant you have to quickly go there, buy and come out. If you don't strike immediately, okay, you can't. See, in our Tirukkural, Thiruvalluvar, a famous Tamil poet says, you should be like a crane, crane. It's a water bird with a long beak. It will be sitting quietly on one leg in the water. If you go to the water area, marsh area, you will see this crane, which will be standing on one leg and with long beak. So it will be looking into the water. It will be waiting. At the right time, when the big fish is coming there, it will strike with lightning speed. It will catch that bird and run away. You can see the same thing with water birds flying birds also. They'll be circling the pond. Suddenly they'll sweep in. That's all. Fellow would have caught a fish and run away. So this is that method of doing it. So the point is, so that is why they say, hey, up to 10% you go with board resolution. No need for shareholder approval. Now your MD says, no, my dear CFO, Mr. Vishal Pandey, I need to do more than this. Yeah, what to do? Then you tell him, sir, we will do 10 now, sir. In the meantime, I'll go for board special resolution, sir. Then we can buy back 25% or less of the paid up capital. Hey, but obviously be careful. Before you ask a doubt, I will clarify it. 10% already over from board now. The balance 15 only now you can buy. So total in any year, listen to me carefully, you won't have any doubt. Total in any year, you cannot buy back more than 25% or less of the, you cannot buy back more than 25% of the paid up capital. So, and free reserves. So, you cannot, it is not 25 plus 10, 35. No, it is 10 through board or totally 25. Whether through board or, if you want one shot, you want to go to 25, then go for a special resolution. You immediately call a general meeting, get the shareholders' approval by way of special resolution and buyback. So, if you want to buy back 25% or less, about 10 up to 25, about 10 up to 25, then you have to pass a special resolution. Okay. So, this is a very simple method of buying back your own share. Okay. Parthrana, you are not alone in this country. There are a lot of youngsters like you who are extremely interested in learning valuation methods from me. But I can't teach you now, and I can't teach you at all because I teach only in B schools, that too selected B schools. The students come there. I don't teach in public enough. I would love to teach you. One, two. First, you become a chartered accountant and acquire the knowledge. Then we'll go to valuation and all. I am giving examples of valuation only to help you understand the operation of Section 68. Idea here is not to advertise my ability to teach you business valuation, and it is not an easy subject. It needs a lot of experience, gut feeling. It is easier to do trading. Better go to the market and do trading. Don't come to me for business valuation. It is very, very difficult, boring, needs a lot of knowledge, needs a lot of experience. It's not worth it. You will make more money in a boom market like this just simply buying any rubbish share you buy now, it will go up only. Okay. Expertise is needed only in a depression when the market is low to identify the real good buys. You know, at that time only people like me will come in and start buying. Now we won't buy. we have already bought. We have already bought. Okay. So Parthrana, your intentions are very good, but the route is very, very tough. Okay. And I'm not trying to discourage you. First, you become the knowledge base should be very strong. Build that knowledge base, become at least intermediate qualified. Then we will talk. Till such time, no. Okay. Otherwise, basics itself you won't understand. All I am saying is how this valuation is arrived at. I'm giving you one more thing. Remember, I may be using one method. See, I use the method taught by a great man called Ashwath Damodaran. See, some of you are interested in valuation. Please Google Ashwath Damodaran. He's a genius, a famous man who teaches in Stern University in the New York School of Business. You can go through. You can Stern. You can go through Damodaran's PowerPoints, which are readily available. But there you will find many technical terms he's using you don't understand. Better you finish your CA Inter and go. You will find you are able to understand what he is saying, or for that matter, what I will be telling you. Otherwise, see, even for smallest terminology, you are having doubt. And one more thing, Ashwath Damodaran cannot teach in Hindi. Okay, of course, there are a lot of people who can teach in Hindi, but to my knowledge, Ashwath Damodaran does not speak in Hindi. He sits in San Jose. He teaches in Stern University, New York University, New York School of Business, where he teaches. I had the good fortune to attend his online workshop during pandemic. I use his book for my courses, but when he offered it, I went and I attended from Damodaran himself. So and Damodaran is 100% not the popular valuer. You got better people in the market out there. Lot of people from Mumbai. There are great geniuses from Mumbai who may even teach you in Hindi. They will teach you better on how to value and all. Okay, so don't think only one person. There are many people out there. But consistent track record, you have to see whether this guy has consistently done multi-bagger. To an extent, I have done multi-bagger only for my portfolio. I don't run any other portfolios. I don't do for anybody else. It's my own hard-earned money because I am a practicing chartered accountant. No provident fund, no gratuity, no leave encashment, nothing for me. I have to take care of myself. So if I don't create my own retirement fund, government is not going to do anything for me. And there's no employer to help me. So remember, practicing CAs are very risky business. Don't come for practice. I'm just joking. Practice is good if you are interested. But again, I tell you, slow and steady, boring. Whereas if you go for employment, immediately you'll get salary. In practice, it'll take a long time to make a lot of money. Salary, you'll get a lot of money immediately. So why come for practice? That's the point. Sorry, this is not required for you. But as a senior chartered accountant, I'm just sharing my view. Okay. Yeah, build your knowledge, Mark. All of you, build your knowledge first. Financial terminologies. All that. And this knowledge of buyback will be very useful. Now, please note, our MCA fellows are making it even more complicated. How? In respect of the buyback of equity shares in any financial year, the reference to 25% shall be construed with respect to its total paid up equity capital in that financial year. This means a company cannot buy back more than 25% of its paid up equity capital in any financial year. Friends, this I'll tell you, these fellows are not accounting guys. They are under secretaries and government servants in the ministry. Maybe they studied political science or they studied economics, like our great finance minister. They are coming and they are trying to talk about accounting. So this is what will happen. See, if all these fellows needed to do was read section 77A, old section 77A. Very clearly, 77A had very clear provision. Just to copy paste it, they would have got 68. Instead, they have to write their own language. Then they miss out on this point. See, friends, in the balance sheet, there are two things. Please look at this. You will understand it better. In the balance sheet of a company, the paid up capital is shown at face value. Got it? In the balance sheet, the paid up equity capital is shown at face value. So this is 10 rupees face value. But if that 10 rupees share, I want to buy in the market, it may not be 10 rupees. See, the market price per equity share for this company, the market price per equity share for this company is 50 rupees. 50. Got it? 50 rupees. Now, if I want to buy this company share in the market, it will be 50 rupees. So let us say this company wants to buy back. It has to find out how much it can buy back now. For that, they are saying, I'm sorry. In respect of buyback of equity shares, reference to 25% shall be construed with respect to its total paid up equity capital. So, what is the total paid up equity capital? 100 crores. Out of that, you calculate 25%. So, this company can buy back paid up equity capital up to 25 crores in face value terms. In face value terms. But face value is 10 rupees, ma. 100 crores divided by 10 is 10 crores, na. 50, it is 50 rupees, na, per share. So if I want to buy that, see, 100 crore is the face value, 10 rupees per share, then 100 by 10, 10 crore. 10 crore shares, if I buy it in the market, I have to pay, am I correct? 50. That means 25% of PC plus FR. So I have to pay how much? Just for the sake of point I'm asking. I have to pay 10 into the entire amount if I'm buying back. Entire amount if I'm buying back, then I have to pay 500 crore. 10 crore into 50, 500 crore. But I can buy back only 25. So 25% of only I can buy back. Am I correct? That is 25. That is, I cannot buy back the entire 100 crore. So 100 divided by 10, 10 crore. The entire 10 crore shares I cannot buy back. Am I correct? Only 2 crore 50 shares I can buy back. Only 2 crore 50 shares I can buy back. That 2 crore 50 shares to buy back, I need to spend 2 crore 50 into 50, 2.5, 20, 2.5 to 20. That comes to 12 crore 50 lakhs. Am I correct? 2 crore 50 lakhs into 50. I have to spend 12 crore 50 lakhs. Now, how to get the 12 crore 50? For that, they're saying you can calculate 25% of PC plus FR. So 25% of PC plus FR. PC is 100. Yep. No. I told you now, paid up capital includes preference capital. So 300 plus another 200, total 500. So on this 500, I can buy back 25%. How much is that? 125 crores. Am I correct? 125 crores. Sorry, it's not 1 crore 25 lakhs. It's 125 crores. Now, number of shares which we can buy back, 2 crore 50. To buy back those 2 crore 50 shares, I need 125 crores. Now, which is nothing but 25% of 500 crores, yeah. So, which is nothing but 2 crore 50 into 50. Am I correct? So, luckily for us, in this example, 25% of PC plus FR is exactly equal to the amount which we have to spend to buy 2 crore 50 shares. Okay. I'm just keeping it open. If you want, I will explain it once. Again, maybe some of you might be finding it a little. There are two limits now you have to see. 25% of paid-up capital and free reserves. This is to calculate the amount you can use for buying back. Then you have 25% of self paid-up equity capital. This is the actual amount that you can, the number of shares that you can buy back. So this company can buy back up to 25% of its paid-up equity capital. That is 25% of paid-up equity capital is 25 crores. 25 crores only you can buy back. That is represented by how many shares? 2 crore 50 shares. How do I get it? 100 divided by 10, 10 crore shares. Out of that, 25% is 2 crore 50. Right. So I can buy back only 2 crore 50. Now, to buy back 2 crore 50, I have to spend how much? 2 crore 50 into 50. Because market, you can't get it at 10, yeah? You have to pay 50 rupees. So 2 crore 50 into 50. That means what? 125 crores I need to spend. Luckily for us, the paid up capital plus free reserves is equal to 500. So 25% of that is 125 crore. So I can go for buyback. Suppose this company share is 60 rupees. You are gone. Because if it is 60 rupees, then can you calculate and tell me what is the amount which is needed? Can anybody calculate and tell me if the price is, market price is 60 rupees? What is the amount? See, I can buy only 2 crore 50 shares. I can buy back only 2 crore 50. That is 25% of paid up equity capital. Total paid up equity capital. But to buy the 2 crore 50 shares, if the market price is 60, how much should I pay? 2 crore 50 lakhs into 60. I get 150 crores. My dear friends, I do not have 150 crores because I cannot buy back more than 25% of my PC plus FR. So it's restricted to 125, which means I have to now do another calculation. You know what I should do? What is the amount I have? 125 crores now. I can use only 125 crores. Am I correct? 125 crores divided by 16. I can buy back only 2 crore 8 lakhs 33,333 shares. I cannot buy back 2 crore 50. Though I can legally buy back 2 crore 50, but the amount required for 2 crore, if it is 60 rupees, will be 150 crore. But I am limited to 25% of PC plus FR, which is only 125 crore. So 125 crore divided by 60, 125 crore divided by 60 gives me 208,333,333.33. That is 2 crore 8 lakhs 33,333 shares. That's all I can buy back. Beyond that, I cannot buy back. Friends, is this clear? Yeah, beautiful. Some of you have really given answer. Okay. Now, Mr. Rama was asking another question. What was that? Earlier also Rama was asking. What was that? Company bought back all shares. Friends, if you go by this, you cannot buy back all your shares now. It will always tend towards zero. Am I correct? It will always, because at any point in time, you can buy back only 25. See, post this buyback, what will happen? The paid up equity capital will become 75. Now you will have to calculate 25% of 75 only. No stage, finally it may become very small number. Again on that only 25%. So to answer Rama's first question, you cannot buy back the whole. If you decided to buy back the whole, don't worry. You go through reduction. Yeah, that is easier. Go to tribunal, buy back everything. And this idea is to buy back occasionally. Okay. Now he is giving me a huge question. I have to read it. One case study, unlisted company having investment by foreign bank, later paid, later acquired by conversion of public company to private company, and later majority investment. What is the point? As from promoter, the holding company becomes Anna, Rama sir, I am ignoring your question posted at 7:31 because we don't have time. And one more thing, it's not clear what is your doubt. Ask a specific doubt relating to this topic, I will answer. If you have a case study that needs to be, that you are not clear with, kindly wait for some other occasion when we can take it up. As of now, I cannot, I don't even know what your question is. So you are giving me this information, is it? Thank you. That's all I can say. So kindly don't mistake me. Don't do this. What I'm going to do is, I'm going to take this and save it. And that is not possible now. Because time won't permit now, otherwise. I'm just copying it and putting it onto my, keep, so that I can just later on refer to what you're doing. But sir, don't get confusing, sir. Leave it. Rama, no more such unnecessarily lengthy postings, which would be wasting my time. Unless you have a specific question which has relevance to my topic, don't ask it. Don't put like this. There are a lot of case studies available. Please go through them. Try to understand the solution to the case study. The idea of giving you a case study is to make it complicated so that it will be as near as possible with the real life. So you have to go through it and try to understand it. If you don't understand it, break it up into parcels, and where it is relevant for me in company law, that topic, you ask me, I will answer. Or else, if you have a query, send it to the Board of Studies as a whole. Definitely, if they're having some company law impact, they will ask me. They will revert back to me, and I will give my view on that. Okay, well-worded questions, clearly demanding an answer, will always be answered. Okay. See, you understood for 50 now. You have understood for 50 now. Now, suppose I remove 50 and put 60, what will happen? This amount will change now. If I put 60 here, what will happen? This amount will become 150 crore. Now, how much I can buy back? See this. This is only 125 crore. This is in crores. This is only 125. I can buy back only 25% of PC plus FR. I can buy back only 25% of 500. Whereas if this is 60, if I put 60 here, this number will become 150. So I cannot buy back 2 crore 50 shares. I can buy back only 125 crore divided by 60. That comes to something like 2 crore 8 lakhs 33,000 shares. 333 shares. Okay. In buyback also, there is a CRR Nagaraju. I will come to it. At that time, you will learn. Don't jump the gun. Right now, we are only seeing the quantum of buyback. So, this is the amount of paid up capital. That is, by this slide will tell you how many shares can be bought back. Here is the amount which can be used for buyback. Okay. That way, both have to be seen. Right. Now, all companies have something called debt is to equity ratio. That is the ratio between loan and owner's capital. That is called debt is to equity ratio. This ratio ideally is 2:1. When you come to financial management, ratio analysis or financial analysis, you will learn that in the balance sheet, the total debt divided by equity should be ideally 2:1. So what they want to ensure is after the buyback, what will happen? After the buyback, the equity will come down in two ways. One, the paid up capital will come down. The reserves also will come down. The free reserves will come down. How? The free reserves which are available for dividend will now be transferred to CRR. To the extent of nominal value of these shares. Na? See, I'm going to buy back for 125 crore. The nominal value is 2 crore 50 into 10, 25 crore. To the extent of 25 crore, I will reduce from free reserves and transfer it to CRR. So free reserves will come down by 25 crore. Paid up capital will come down by 25 crore. Got it? So in those cases, after the buyback, the equity will come down. Even if the equity comes down, the ratio should still be maintained. The ratio should still be maintained to is of the debt. The debt should be at least 2 times. If after the buyback, the debt equity ratio becomes more than 2:1, there is debt becomes more than 2 times equity, not allowed. You have to restrict yourself to such a way that you will buy back only to the extent debt equity will remain 2:1. Again, this is to protect the creditors. So that, like Rama is saying, na, if the company keeps on buying shares, they might make it zero. Na. They cannot. This is one more condition which will prevent. If the loans are there, then you can only buy back to the extent where the equity will be 1 for debt 2. If the you keep on reducing it, you can't go beyond the 2:1 ratio. So to answer Rama's question, this is one more reason why a company cannot buy back all its shares and make it zero. You understand, Mr. Rama? The people who wrote the law are also very intelligent. No, they also know what they are doing. Huh? Can buy back times in a year. How many times can it buy back? I will answer that question. Just give me 1 minute. I will answer that question. You take a 10 minutes break. Today, no break. You just go for a break because I have to finish the topic, ma. Why don't you have a little responsibility, Ja? If you want a break, just go and come. Even I would like to have a break, but think okay, you have a break, 10-minute break. You have to complete debentures, ma. After this, still you have debentures topic, and I want to work out some problems. Anyway, chalo, sir, 5 minutes break, sir. Okay, sir, 5 minutes break. Okay. So, continuing. So, the debt to equity ratio should be maintained post buyback also. Okay. Now, the central government may by order prescribe higher ratio, meaning higher than 2:1 means what? 3:1, 4:1, sometimes even 7:1. For infrastructure companies, it can be as high as 5:1 and all. Because they need to, the amount of loan for them will be higher. So that like that. So, but central government may prescribe higher ratio for any class or classes of companies, not for any specific company, but a class of companies. Okay. And shares for buyback should be fully paid up. Okay. Fully paid up shares only can be bought back. Buyback of shares of listed companies to be as per SEBI guidelines. Okay. So for listed companies, there is a additional guidelines given by SEBI, mainly relating to price at which the buyback will happen. See this amount because market price is there, na? So which price to take? So there are some rules and regulations for that. For unlisted companies and private companies, you have Rule 17. Okay. Mr. John, thanks for being back. Uh, your question is answered here. I'm sorry, not Mr. Jha, Mr. Rama. Offer of buyback not to be made within 1 year of closure of preceding buyback. So a buyback will open, no? It will again close. Usually the buyback will be kept open from for about 15 days. It will be kept open 15 days. So once the buyback closes, from that day for another 1 year, you cannot make an offer of buyback. So Rama was asking that question now, where he was saying, can company buy? The question is a little vague. My understanding is Mr. Rama is asking, how many times can a company buy back in 1 year? In 1 year, only once. Because if you make one now, for another 1 year, you cannot make another. From the date of closure, you cannot make another. Okay. Correct. Even for banks and financial institutions, it will be very high. Correct. You're absolutely correct. Debt equity ratio will be higher for banks. Absolutely. So sometimes it will be as high as 5 times, 6 times, or 10 times also. Depends. Absolutely. So for certain class of companies, they can prescribe higher rate. One more thing, every year, Tata Consultancy Services makes an offer of buyback. Every year, Tata Consultancy Services makes an offer of buyback. Every year it makes. You just check up since pandemic year, they have been doing it. I also sell. I offer my share because I have a good holding in TCS. TCS is a very good company. It is not undervalued. But what Ratan Tata is doing or Tata Group is doing is, see now earlier dividend was not taxed. Now dividend is taxed. Recipient. Earlier there was a dividend distribution tax. Now dividend is taxed in the hands of the recipient. So to avoid that, what they are doing, instead of giving dividend, they are giving a buyback offer. So what happens now? That small portion of buyback, for example, this time they bought back 7 shares from me or 6 shares, 11 shares like this. Small amount, it will come now. That is my dividend in a way. Because that amount which I get now, the tax effect on that will be very low. Because only the difference between my purchase price and my sale price will be taxed as capital gains. That too being a listed share, 10%. And for me, long-term capital gain, so 10% only. So definitely the taxation for buyback is lower than dividend. So sometimes buyback is also used for tax planning by especially TCS. Now every time it comes now, I will think I should not give because TCS share is going to go really high. 100% it will go. But then I will be seeing 7 shares. Okay, if Ratan Tata is taking his dividend that way, I will also take my dividend that way. Like that I used to take. But of course, they also declare a dividend, but they will give it in the form of this also. Okay. So recent buybacks, if you see, TCS is coming regularly. You can go and check up TCS buyback document. It will be open for about 15 days. So my broker will call me. Even Wipro made a buyback offer. Asim Premji got his money that way. So I also have the Wipro shares. I also sold. I mean, whatever they gave me, I gave an offer back. I said, because the price at which I bought them is very low. And according to me, the market is overpriced. Now, even now it is overpriced. So I mean, I may be wrong, but better start looking at booking profits from now on rather than buying and waiting for money. Now onwards, it will be higher and higher and higher. People like me who are bought and sitting are waiting. This is our opportunity to exit now. Again, we will enter it when the market collapses in 28, we'll enter. 28, 27 end or 28, 29, 28, it will collapse. 28, when it collapses, we'll enter again. Why? Now is the time to slowly exit and keep out. So nearing 26, 27, fully get out and watch. Maybe just watching the game. Of course, it will go up after that. People will be telling you are a fool and all. I will listen carefully. He says, I'm a fool, sir. You are all very intelligent. Then again, it will go to the peak. At that time, people will be going mad and buying, buying, buying. And suddenly, one fine morning, some reason for collapse there. You will give some reason, but finally it will collapse. And when it collapses, it will be a bloodbath. At which time, the same share that I sold in 26 or 27 at a huge price to the market, I will buy back from the market at a very, very low price. Sounds like taking money from small children. Now, imagine if a small child is having a lollipop and you take that lollipop from the child's hand, how cruel it is. That is how I feel when I make such money in the market. When I see all these innocent fools, going around buying at high prices, in spite of warning, they will buy. Then when the market collapses, they will sell. That is another beauty. They won't hold it. They will sell because they would have heavily borrowed to buy. So the interest will be very. So they will sell at a heavy loss and whatever. So when they want to buy at the high price, I will sell. Then when they want to sell at a very low price, I will buy. This may sound, when I'm telling like this, it may sound very silly also. But that is all. I have done it 2 times. I have built 2 houses based on this. Okay. So sometimes I feel, like taking lollipop from a child. But what to do? These children will never listen. They will again go and buy. Again, they're going to do the same thing for me. My final retirement fund, they're going to give it to me. Okay. They're going to make my money for me. Anyway, good tactics or bad tactics. This is the fact. But even you won't believe in 26, 27 or 27, 28, if I come to you and say, don't buy now, it's very high. Mr. Srikanth, you don't know, sir, you are Buddha. Like that, you will advise me. Then definitely, good sir, please buy, sir. Like that, even my share you buy, sir. Like that, I will give it to you. And again, I'll eagerly wait. It will collapse. When it collapses, please give it back. Thank you. Well, it won't be you. It will be somebody, market. That's why Warren Buffett doesn't call it individually. He says market buys from me at huge prices and market sells back to me at low prices. That's what Warren Buffett says. Anyway, fantastic. Today, because the topic is share capital and debentures, we are talking a little about share market. Share market is a very, very mathuram. That is, talking about share market is very, very interesting. Talking about share market is very, very interesting. Making money in share market is difficult. Everybody can talk about share market. Actually, no. At both stages, I will never become enemy because at both stages, people are more than happy to buy and more than happy to sell. That is another beauty of the market. This market is an faceless creature. Nobody's face is there. So how can I be? Hey, that way, if I'm my buying and selling is minuscule in the market. Yeah, there are bigger people than me doing the same thing. Intelligent people who are doing far far more volume than me, and it happens every time beautifully. That's about 10 to 20%. See the same thing if you watch the movie, The Big Shot. If you watch the movie The Big Shot, you will understand it in reverse. In a way, what I'm doing is a big shot. See, in a way, so you go and watch the Big Shot movie. The same thing. When the market was foolishly going up now, a few people took the risk and went short. And that was in the derivative market. So watch that movie, The Big Shot. And maybe you'll understand a little bit about contrarian techniques and things like that. Anyway, good show. Moving on, sources of funds for buyback. Where will I get buyback? Free reserves, securities premium account. See, free reserve does not include security premium. But if you have securities premium account, you remember this is the fifth usage which you can use for the security premium account, right? Then the proceeds of the issue of any shares or other securities. So just like preference shares, you can buy back out of free reserves. That is the profits available for dividend. Or securities premium account extra added here, because securities premium account can also be used for buyback. So if securities premium account is there, that also I can total. Here in my example, I given only free reserve. Suppose I had one more line security premium, that can also be included in calculating 25%. So for calculating 25%, you will take paid up capital, equity and preference, then free reserves, securities premium. Total, you will find out 25% you can buy back. I'm sorry. This is the, yeah, you can calculate 25% on that. Then, if that is not sufficient, if you want to buy back more, then you can do so only by issue of any shares or other specified securities. But be careful. You cannot issue preference. If you're going to buy back equity, right? You're going to buy back equity. So you cannot have issue of equity. It has to be some other security. Okay? No buyback of any kind of shares or other specified security shall be made out of the proceeds of an earlier issue of the same kind of shares or same kind of other specified securities. See, specified securities, you already know by now. It is only equity shares now, or shares convertible into equity shares. Okay. So equity is a specified security. So you cannot, if you want to buy back equity, you cannot make a fresh issue. It has to be a fresh issue of either preference or debenture or whatever, right? Now, from whom can I make the buyback? From the existing shareholders, right? On proportionate basis, meaning I can go to my existing shareholders, just like rights issue, I am making an offer to the existing shareholders. Buyback is the reverse of rights now. Where I'm saying you buy additionally one share, I'm saying, hey, all you guys are holding shares now. For every 100 shares you're holding, I will buy back 2. For every 100 shares you're holding, I will buy back 2 proportionately. So anybody who wants will make a application, we'll send the confirmation, we will pay them the money. So they will give an instruction to the broker. The broker will say we are ready. Then the shares will be transferred to the company's DP account. Money will be credited to the person's registered bank account with the DP. That's all. Simple. I tell my broker, I'm okay with TCS, proceed. So he will go there and press the whole thing and submit. 7 days later, money will come into my bank account. That's all. Matter over, my shares will go. So my share balance in DP will come down. My bank balance will go up. That's all. Everything electronic. From the open market, which means I'm not doing it proportionately. I'm going to the market and saying, anybody got my share, give me. Whatever price, I will take it. That way I'll get the advantage of lower price in the market. Whereas existing shareholders, I might have to give them a little better price than the market. Because, see, am I a fool to sell the share when it is quoting in the market at a higher price? So invariably, you will find buyback will be given to the, if it is given on point number A, it will be at the price slightly above the market price. Why? Because think about what I said. When Maruti was quoting at 900, its intrinsic value was 3,000. So if Maruti wanted to go for buyback, even if they offer 1,200 rupees, still they are making a good buy, because 3,000 is the intrinsic value. Got it? And from the open market, or by purchasing the securities issued to employees pursuant to an ESOP. See, at the time of ESOPs, we might have told the employees, hey, we are confident that the price of the share will go up now. But believing us, you have purchased the ESOPs. Now, the price has gone to a price which is below market, which is below our issue price. We gave you the ESOP at 600, thinking that it will go to 800, you guys will make money. But now we find that it's going at 400, we will buy it back from you. Yeah. Okay? At your 600, we'll buy it back from you. So that could be a condition in the scheme. We'll buy back. So that is another example of buyback from employee shareholders. Buyback should be completed within 1 year from the date of passing of the special resolution. Okay. The shares or securities so bought back shall be extinguished, meaning physically destroyed. If it is a records of a depository, it should be deleted within 7 days of last day of completion of buyback. It is very, very important. Post buyback, those shares will be extinguished. So the paid up capital will be automatically reduced but without going to tribunal and all that. You understand? 68 is an exception to 66. So no tribunal, nothing. SEBI takes care if it is a listed company, MCA if it is a company. Just see to it that your balance sheet, the paid up capital is reduced, all entries are passed, and the shares are, if the physical securities, they have to be physically destroyed. If it is records in an electronic records of a depository, it should be deleted. Okay. Company not to make further issue of securities of the same kind within 6 months. No more buyback for 1 year from the end of closure, and no more further issue of securities for 6 months. Okay, nothing. Because you can simply buy back and issue. No, 6 months, nothing. Exception is, of course, bonus issue, conversion of preference shares or debentures, and discharge of subsisting obligation. Subsisting means current, now existing obligation on warrants, stock option schemes, and sweat equity. Where you are given a stock option scheme or a sweat equity agreement by which you agreed to allot shares to somebody on fulfillment of a condition. He has fulfilled it. It's a subsisting obligation. You have to. So other than this, you cannot make a private placement letter or a IPO, I mean FPO, nothing till 6 months from this buyback. So special resolution, board resolution, Also declaration of solvency should be given in form SH9, signed by at least 2 directors, one of whom shall be MD. So declaration of solvency also should be given. Why? Because an insolvent company means a company which cannot pay its debts in full should not buy back. Anyway, the debt to equity ratio will also be there. Still, they are saying if you want to go for a buyback, the director should confirm that the company will be solvent for a minimum of 3 years from the date of buyback. Okay. Also, you have to maintain a register of shares or securities bought back in form SH10. These are procedural. And after completion of buyback, a return should be filed in form SH11 with ROC and SEBI. That is all. No other control, no tribunal, no RD, nothing. No going to the creditor, nothing. You just have to ensure that your return is wherein you will only give all the details and all. That's it. Including compliance with the ratio and all that. Declaration of solvency should be verified by an affidavit, means a sworn statement that the board has made a full inquiry into the affairs of the company and have formed an opinion that it is capable of meeting its liabilities and will not be rendered insolvent within a period of 1 year. I said 3 years, I'm sorry. Within 3 years is for winding up. This is 1 year of the date of declaration adopted by the board. Okay. Now, when you are calling for that notice now, for that buyback, that special resolution, for that explanatory statement will be there. Therein, you have to give full and complete disclosure of all the necessity for the buyback, class of shares or securities intended to be bought back, amount to be invested, and time limit for completion of buyback. All this has to be very clearly told. Okay. And as I told you, an amount equal to the nominal value of the share should be transferred. So compulsory transfer of a sum equal to the nominal value of the shares to the CRR account. So in our example, nominal value is 10 rupees. So only the 10 rupees into 2 crore 50. The 2 crore 50 will be transferred to CRR, which means to that extent my P&L account or general reserve will come down. And you are all aware, CRR cannot be used for declaring dividend. It can be used only for issuing bonus shares. Same as redemption of preference shares, nothing new. Mr. Srinivasan, what is the meaning of... I'm sorry. Sorry. Hey, I'm so sorry, boss. Srinivasan sir, please note. The shares or securities bought back shall be extinguished and physically destroyed. How can they be reissued, ma? Some other new shares can be issued, boss. But these shares are gone, ma. How they can be reissued? Have you understood? So please, I hope your question is answered. But it need not have been asked, na? Chalo. So in certain cases, a company cannot buy back its own shares, directly or indirectly. Prohibition. Okay. For example, when there is a default in repayment of deposits, the same things, just like issue of differential rate shares, repayment of deposit, there is a default with interest, redemption of debentures default or preference shares default, payment of dividend to any shareholder, whether equity or preference, okay, repayment of any term loan or interest thereon. Okay, now where default is remedied, the buyback may be made after the lapse of 3 years. So in all these cases, if there is a default, even if the default is remedied, you cannot do buyback for 3 years. Only after 3 years of remedy, you can go for a buyback. Remedy means what? Suppose you have not repaid the deposits with interest. You repay it. That means it is remedied. The repayment has happened. Then from that day for 3 years, you cannot go for buyback. Only after that. Again, don't use words like buybacked. There is no buybacked. Srinivasan said, the bought. So it's not buybacked. It is bought back. Back should not be touched. Only buy is the verb there. Only that verb should be conjugated, which means buy will become bought. Bought back. Okay. I know I'm being very purist in language. I know some of you will get angry with me for correcting your English, but try to pick up the logic. See, here buy is the verb, and only the verb should be conjugated. Back is not a verb. Okay, buy back. Okay, it's a compound word. In that, buy is the verb. Only the verb should be conjugated. Similarly, mother-in-law. Mother is the subject, not in-law. So only mother should take plural or singular. So plural will become mothers-in-law, not mother-in-laws. Okay. Just it needs a little bit of application of correcting your English, which is not my subject. But unfortunately, this subject is to be written in English. And there may be another idiot like me correcting the paper who is puristic in the use of English. Am I correct? Then you are in trouble now. If the correct man correcting your paper is also being very, very puristic about English. But luckily for you, if that fellow also does not know English, then you are safe. So long as he is happy with the law, then you are happy. This is told not with the intention to hurt anybody, but as a teacher, I want you to become further better than what you are now. Yeah, I don't know how old you are. If you are that another gentleman I asked and he then said, yeah, I'm 62 years old. So I don't want to ask anybody's age. I am 58. Now you see whether you are younger to me or elder to me and decide. Even if you are elder to me, as a teacher, I'm telling, please improve your English. Okay. Prashant Rai, we don't have time. I've already explained it many, many times. Please download this video and watch it. If you still have doubts, we'll see, but not now. Because I have very little time, I have to complete the syllabus. At the time of explaining it, I gave you enough opportunity to ask me. Now it is too late to do this. Okay. Let me complete it, and if I have time, I will take it up. Penalty is there. In case of default in 68, penalty 1 lakh up to 3 lakhs. Fine 1 lakh up to 3 lakhs for officer and company. I told you about this because I've explained enough about why of buyback. I don't have to waste your time. Are all buybacks successful? Are all buybacks successful? Not necessarily. See, TCS announced world's biggest buyback, India's biggest share buyback. It was via the tender route. In 2018, Reliance Industries carried out. Reliance Industries buyback achieved only 38% of the target. And the stock gained 8% during the buyback. Why do you think Reliance failed in buying back its shares? Because value is too good. Yeah. Nobody will sell. If Reliance makes a buyback offer, I will laugh at him and Mukesh Ambani and say, okay, buyback, very good, keep it. Because I know my Reliance share is worth much, much more than what he's giving me today. I just have to hold it. That's all. Nobody will sell. Chalo. Sir, Mr. Prashant Rai, if I can complete debentures by the end of the session, I will go back and teach you 10 and 25. But allow me to complete debentures. Debentures. See, basically, debentures are debt instruments. The word debenture is defined as including debenture stock. You know what is a stock? A stock is a bundle of shares. Now, like that, debenture stock is a bundle of debentures. That's all. Same logic, bundle of debentures. And debenture includes bond also. See, only in India, we use the word debenture for a corporate bond. Suppose you go abroad, anywhere in the world, they even including our neighbor Sri Lanka, or maybe Sri Lanka, they may use debentures, or Sri Lanka, Bangladesh, Pakistan, they may use debentures because of the old colonial influence, because of England and all. But if you go to US or Europe, anywhere other than England in Europe, they will not use the word debenture. A bond issued by a company, any loan instrument issued by a company is called a corporate bond. So in India, we use the word debenture. Therefore, they say, even if it is called a bond, we in Companies Act, that treatment will be as if it is a debenture. Okay. So by issuing debentures, a company may source debt finance from the public. So please keep it very clear in your mind. Share capital is equity. Share capital is equity. Equity preference, all are owners' capital, whereas debenture is a debt. Debenture shall not carry voting rights. They are debt. Yeah. How? He is a lender. He has no voting right. Except suppose there is a meeting of debenture holders. In that meeting, all debenture holders will have a voting right. At the meeting of debenture holders, that is called class meeting. But in the equity holders meeting, if the debenture wala comes, will simply chase him out. He said, you have no right to be here. You don't even, no notice was given to you, go. Like that. Now, convertible debentures are debentures with an option to convert wholly or in part. So, means 100 rupees debentures may be partly convertible, meaning what? 25 rupees may be convertible, 75 rupees may be repaid or redeemed. So, where they are wholly convertible, they are called fully convertible. There may be an option to the debenture holder, either to convert or to take his money. If it is compulsorily convertible, then the debenture holder has no option. He has to take the equity shares. So that is also there. Now, if you want to issue convertible debentures, you have to pass a special resolution, because one day or the other, these convertible securities are going to become shares, equity shares. So the equity shareholders have a right to vote on that. They can simply say no. So you need a special resolution. In case the debentures create or constitute a charge, means they are offered as a there is some asset belonging to the company has been offered as a security. So the debentures, in case the debentures are not repaid, the asset can be sold. So that asset has been given as a security. So the debentures are called secured debentures. Otherwise, they are naked or unsecured debentures. Okay. Now, issue of secured debentures is governed by Rule 18. Basically, the Rule 18, they will be asking you to appoint debenture trustees. All secured debentures shall be redeemed within 10 years from the date of issue, except in the case of infrastructure companies, where you can go up to 30 years. Just like preference shares for infrastructure companies, debentures can also be redeemed within 30 years. So, on the basis of security, you have secured, unsecured. On the basis of conversion, you have convertible, mandatorily or optionally, compulsorily or optionally, partially or fully. Or you have non-convertible debentures, which have to be fully redeemed. Finally, you have redeemable and irredeemable. You cannot issue irredeemable debentures. You have to redeem them within 10 years. If only naked or can be irredeemable. If it is secured, it has to be redeemed within 10 years. See, I'll tell you one more thing. When you come to deposits, acceptance of deposits, you will see that unsecured debentures which are not available, no securities available, will be treated as deposits. So that is why they are not covering here. You understand? That is why they are not bringing it here, because this unsecured debenture will be classified as a deposit under the Deposits Act. under the deposits rules. When we come to acceptance of deposits, very shortly, maybe next week, I will tell you about that. Okay. So every company should create what is known as a DRR, Debenture Redemption Reserve. See, out of the profits for every year, you have to create a DRR. The DRR shall be utilized only for redemption of debentures. Portion and show it as debenture redemption reserve, which means to that extent you cannot touch the profits. So DRR shall be created in respect of non-convertible portion only. See, the convertible portion will anyway be converted. For that, no money is going to be paid. Only for the non-convertible portion, you have to earmark that amount and keep it as DRR. Okay. The company shall create debenture redemption reserve in accordance with the following conditions. Please note, all India financial institutions and banks, whether public issue or private placement debentures, they need not have DRR. NBFCs, housing finance companies, other listed companies, all listed companies, no other than NBFCs, housing finance companies. If the debentures are given on public issue, then no. You might see, remember, even an unlisted private company or an unlisted public company, if it is issuing debentures, will have to get its shares listed, get debentures listed under SEBI. So, if it is listed through public issue, no. If it is given through private placement, that is up to 200. Do you remember? If that route you are going, then those debentures, you have to create a DRR up to 10% of the value of outstanding debentures. Up to 10% of the value of outstanding debentures. Now, so this is debenture redemption reserve. In addition to that, see, they also want the company to keep some ready cash, not lock up everything in fixed assets or long-term assets. So they are saying you have to have deposits in eligible deposits and securities of a certain portion of the debentures which are maturing during that year. That is, wherever a company has issued debentures and it is supposed to redeem its debentures during a financial year. Suppose it has to redeem a debentures during the financial year. Then, on or before the 30th day, okay, in each year, it should invest or deposit not less than 15%, 15% of the amount of its debentures maturing during the year ending on the 31st day of March next following in any deposit with scheduled banks. Unencumbered. Unencumbered means the government security is not offered as a security for any loan. It is free from any encumbrance. That security is not offered as a security for any loan. Similarly, unencumbered securities and bonds specified in the Indian Trust Act. For example, NHA bond, RRC bond, like that, some specified bonds are there. They are all safe and they have been prescribed under the Indian Trust Act. So a trustee can invest the trust funds in these securities and bonds. So such cases, you can invest. The idea is these amount, this 15% should be kept safely. And so that whenever you have to redeem, at least 15% will be readily available as cash in the form of ready money. Okay? So the above amount should not fall below 15% at any time. Now, ABC Limited, an unlisted public company, issued 100,000 partly convertible debentures of rupees 100 each on 1st October 2017 on private placement basis. So 100 rupees. Out of rupees 100, rupees 75 is convertible into equity shares and rupees 25 redeemable on 30th September 2021. So non-convertible portion is only 25. It is also known as caucus. It is known as the non-convertible portion, is known as caucus. and the 75 is convertible portion. So remember, please remember, DRR should be calculated only on non-convertible portion. Also, reserve should be created only on the amount to be redeemed. So 75% is convertible. Only 25% is non-convertible and redeemable. So on that amount, you have to create DRR. What is the amount to be deposited for the financial year 21-22? And what is the due date for deposit? And what is the amount of DRR? You cannot issue irredeemable debentures, unless they are not secured, in which case they'll become deposits and only 3 years you can keep. So there is no irredeemable debenture in India. Okay. So don't confuse convertible with irredeemable. Okay. So Parth Rana says creditors have interest in their principal payment with certain interest, but owners have interest in companies. Correct. Your statement is well made, and I appreciate what you're saying. No reactions, but appreciation. Can anybody give me an answer for this? If not, I will tell you. So what you have to do, on 1st October 2017, they issued it. Okay. Now, these debentures are now going to be maturing on 30th September 2021. Right. So on 1/4/2021, you are the CFO. So you have to look at what are the debentures maturing, what is the total amount of debentures outstanding, what is the, and remember it is an unlisted public company, therefore it has to create a DRR on 10% of the value of the outstanding debentures. On 31st, see, on 31st March, okay, on 31st March 20, whatever the date, sorry, on 31st March 2020, what is the, I'm sorry, on 31st March 2021, what is the debenture value? 100, am I correct, into 1 lakh, 100 lakhs. Out of that, only 25 is redeemable. The convertible non-redeemable portion, you leave it. On the 25 lakhs, only 2,500 lakhs, out of that 25 lakhs only is redeemable. On the 25 lakhs, I have to create a DRR at 10%. That will be 2,50,000. 2,50,000. Okay. DRR is not 15%, DRR is only 10%. The amount to be deposited is 15% of the debentures to be redeemed on or before 31st March. On or before 31st March. So that is again the redeemable portion of 25 lakhs on that 15%. So already 2.5 plus 125, 3,75,000 is the amount to be deposited. DRR is 2,50,000. Okay. Swarup Sahaya, DRR is 2,50,000. Amount to be deposited is 3,75,000. Okay. So that is what you have to understand. Clear? See, whenever a company issues a prospectus or makes a public offer, then debentures to the public or members exceeding 500 people, if it offers debentures, it shall, before issue or offer, appoint debenture trustees. Okay. The duty of the debenture trustee is to protect the interest of the debenture holders and redress their grievances. Anything that affects the, see, going by Parthrana's own words, no, anything that affects the creditor's principal repayment or interest or the debt to equity ratio, anything that prejudices them, anything that affects their interest, the debenture trustee should protect. Okay. Now, the degree of care and due diligence is required of him to be maintained by the debenture trustee. The company cannot quietly put in the debenture trustee deed a clause saying, in case there is any liability for the debenture trustee, we will meet it, indemnify it, if he does not show. No. Any such clause exempting him is void. Okay. But if you still want to do that, you can exempt him, provided this is accepted by a majority of debenture holders, that is not less than 50, holding 51, holding 3/4 in value. If even the debenture holders themselves are saying okay, then no problem. If majority of the debenture holders holding 3/4 in value are saying, hey, even if that fellow does not have any care and due diligence, you indemnify him. If they are agreeing, see, who will agree? Which debenture holder will agree? So the debenture trustees have to exercise the degree of care and due diligence required of him as a trustee. It is the duty of the company to pay interest and redeem debentures. In case the debenture trustees come to the conclusion that the assets of the company are insufficient or are likely to become insufficient to discharge the principal amount as and when it becomes due, then the debenture trustees may file a petition before the tribunal. Tribunal may by order impose restrictions on incurring further liabilities. So the tribunal will say, look here, no more debts, freeze, control your debt, repay these guys or do something about it. Before that, you cannot borrow more. Like that, they can protect the debenture holders. In case there is a failure to redeem the debentures on maturity, the debenture trustees will make an application. Either all or any of the debenture holders or the debenture trustee will make. And the tribunal may by order direct the company to redeem the debentures forthwith. See, the tribunal can only direct, the asset should be there. What the tribunal will do is, they please take the security, sell it and pay yourself. Okay, they can do that. A contract with company to take up and pay for any debentures may be enforced by a degree for specific performance. Meaning what? Suppose Mr. A has entered into a contract with the company to take up and pay for debentures. Okay. And debentures means he has agreed to take up 5 crores worth of debentures. Later on, he says, sorry, I'm not going to take up the debentures. I'll pay you 50,000 rupees, 1 lakh, whatever, 1 crore like that. Now, sorry, the company can say, no, we will want specific performance. You agreed to take up debentures. Now take it up. Give me my 5 crores. Like that. So that can be enforced. Obviously, to enforce it, you have to go to court. Okay. And where you have to ask for specific performance. Specific performance is one of the remedies for a breach in contract. If at all you remember your Contract Act, you will remember one of the remedies for breach of contract is specific performance. So here, agreement to take up any or pay for any debentures can be specifically enforced by specific performance. In case there is any default in complying with 71, fine is there for officers only from 2 lakhs to 5 lakhs. Now, I have exactly time to complete it. Still, I wanted to work out some problems and all that. Don't worry. Our next class, somebody like Rahul Sharma was giving a very big thing. Sir, I am a little student and all that. Sir, don't worry. Idea is not to say, you can give me suggestions. You are welcome to give me suggestions. First point is you want to give them some idea about the or that you are having a timetable. And that Board of Studies is giving you a timetable. So if you see the timetable, you'll see what is the classes allotted. Yeah, and you can come prepared for that class. Anyway, our next class will be on 14th. Inshallah, when I'm hoping and planning to take up acceptance of deposits by companies. Topic to be taken up on the next class, which is on 14th. My next class, 14th, we'll be taking up acceptance of deposits by companies. Post Diwali, we'll do that. Okay. So now, one more gentleman, Mr. Prashant Rai, wanted to talk about 10%. Say, I feel bad that if I don't answer that question as a teacher, I feel bad. So I will go back and explain one more time to this gentleman using this. Sir, please listen to me, sir, Mr. Prashant Rai, because I'm taking an effort. After the time of the class, I'm spending 3 minutes to explain to you what is that. First is, company can buy back up to 25% of the paid up equity capital. So, up to 25% of its paid up equity, total paid up equity capital. So, in this example, the total paid up equity capital is 100 crore. That means I can buy back up to 25% of that, which is 25 crore. This amount is calculated to determine the number of shares which can be bought back. So 100 crore is the paid up capital. Face value 10 rupees. So how many shares that this company have? 100 crore divided by 10. 100 crore divided by 10. 10 crore shares. 10 crore shares. Okay. Out of the 10 crore shares, you can buy back 25%. That means how many shares we can buy back? 2 crore 50. Got it, sir? So this 25% limit on total paid up equity on face value is given to ensure you will not buy back more than 25% of the equity capital. But now, to buy back this share, see, so you are entitled to buy 2 crore 50 lakh shares. The face value is 10 rupees, but the market price is 50 rupees. So to buy back 2 crore 50 shares, how much you have to spend? 2 crore 50 into 50. It comes to 125. Sorry, not 2 crore. Yeah. 2 crore 50 into 50. It comes to 125 crores. Now, this is the amount which can be used for buyback. For that, the limit is 25% or less of paid up capital and free reserves. So, for calculating that limit, you can take paid up capital, which includes both equity and preference, and free reserves. Also, if you remember securities premium, if securities premium is there, that also you can total. On the total, you apply 25%. In our example, when I apply 25% on 500 crores, I am getting 125 crore. Luckily for me, this is exactly the amount I need for buying back. So I can buy back each at 125 crore. So I will be satisfying 25% limit. I will be buying back 25% of paid up equity capital, 2 crore 50 shares into 10. I will also be buying up, the amount I'll be using will be restricted to 25% of paid up capital and free reserves and security premium. Okay. So this is what it is. Friend, I have done my best to explain to you. If you still don't understand, I will be sending this PowerPoint to you. At that time, you go through it and you try to understand. Okay. Or work out one or two. Hey, actually, you will be getting this in accounting also. Friends, date of deposit in the previous example is not. Date of deposit, I will tell you. No, that's a good one. Hey, you know that, yeah, come on. The date of deposit, you don't know. See, we are looking at 31st March, 30th September 2021, yeah. You are sitting on 31st March 2021. So, on or before 30th April 2021, on or before 30th April, it will be on or before 30th April, you have to deposit. Sir, in page 4.68, one second, I'll just check. Why correct answer is C and not A? One second. 4.68. Maybe they have not taken this into account. I don't know, ma. I will go through it now. If I can answer it, I'll answer it. Otherwise, in the next class, I will answer it. 4.68. Where is it? 4.68. MCQ. There is no such MCQ, ma. There is no such MCQ. Let me see the MCQ questions. Maybe if there's a buyback question, we will see. MCQ, in second. The MCQs are on 4.87. One second. Litigation. I'm not able to locate what you're telling, Prashant Rai. It's too late in the day. Not able to see that question. Can you give me MCQ question number? No, you do one thing. You give me the question number in MCQ. The question in my printout, the questions are on 4.68. Okay. In the next class, I will go through it and come. At the time you tell me. As of now, I am not able to locate your any question in 4.68. Maybe I will have a look again. 4.68 special resolution buyback is not exceeding 10%. Offer of buyback shall be made. Most illustration. Buyback with board resolution is allowed if amount involved is not exceeding 25%. One second. This is, I think you're talking about that MCQ. I got it. Buyback with board resolution is allowed if amount involved is not exceeding 25%. Anna, here you see, Mr. Prashant Rai, see this. One sec. One second. Right. Now, this is a question where, what does it say? Buyback with board resolution is allowed. For board resolution, what is the amount? 10%. So, not exceeding 25% of total paid up, not exceeding 25% of total paid up equity capital, no. Not exceeding 10% of the total paid up equity capital and free reserves, not exceeding 10%. So, your question is very good question. Hey, you are asking. Now I understand what you are asking. One sec. No. It is there. I saw it, Madhav Tiwari. I got it. One sec. Why is it C and not A? Actually, it cannot be A, ma, because up to 10%, it is enough if you get board resolution. Okay, up to 10%. So the correct answer should be C only, not A. You have to understand it because up to 10%, it's already, I told you at that time, board resolution only. Actually, this question is my question. I only said it. Your real doubt should be, Mr. Rai, why it is not D? Because this paid up thing, equity capital is 25% now. Our friends in MCA have not extended this to 10%. So, when the board resolution is to be passed, the limit applicable is up to 10% of paid up capital and free reserves, you can buy back. Only with board resolution. Okay, that is it. If it is 25%, then it is special resolution. If it is 10%, then only board resolution. I hope you are now cleared, Mr. Prashant Rai. If you put a confirmation that you have understood, it will be great. But some people, not Prashant Rai, lot of people, however much clarity comes, they will get confused here. Some people, even including me and some of you, little bit of clarity is given, they will understand their Bhushan. And I'm sure Prashant Rai is a brilliant man and he has understood. Boss, I have seen the illustration and I have answered your question. Before the next class, I will upload an assignment. Thank you, Mr. Prashant Rai. Yeah, your doubt is well taken. And this is a question you will find in my assignment also. Not because I'm taking from the Board of Studies material. It was given as an assignment maybe long ago, before this version of Board of Studies material. Okay, it is there. It belongs to the Board of Studies. I'm not claiming ownership. It belongs to the Board of Studies. Okay, and okay, good show. So we are entering the Diwali season. So all of you will be, for the next 4 days, you will be busy with Diwali. No. Okay. See, I'll end with the Subhashitam in Sanskrit. Okay. Vidyarthi Sukharthi Tejate Vidyam. Vidyarthi Tejate Sukham. You got my point? Sukharthi Tejate Vidyam. Vidyarthi Tejate Sukham. That is, a man who is interested in happiness and enjoyment, he loses education. But a man or lady who is interested in education, Tyajate Sukham, they will sacrifice happiness. So CA students have to be Sukharthi or Vidyarthi. You should be Vidyarthi, not Sukharthi. So for you, this 1 year, if you are very serious about May 20, a little bit you enjoy, you have half a day, 1 day. But even on Diwali day, I want you studying a little bit. I have done. No Diwali. Then they go on to ask, Vidyarthi Kutho Sukham, Dhanarthi Sukharthi Kutho Vidyam. Where is a man who is only interested in pleasure, where is his learning? He will never become a learned man. A man who is only interested in, learning, how he can have Sukham. So either you have Sukham or Vidya. If you want Vidya, then Tyajate Sukham. So my humble advice to you, I have also done it myself when I was your age, at the age of 19, 18, 19. Even at the age of 22, I was married. My wife, I was engaged to be married in 91 when the ACS exam will come on 31st of December. In those days, the ACS exam will start on 28th, 26th, and go on 31st of December. And I was one guy who enjoyed my New Year parties. But 1990, 1991, 31st December, nothing. Okay? Vidyarthi Tejate Sukham. If you are interested in CA, sorry, for next 2 years, forget Sukham. But after that, you will have unending happiness. Once you become a chartered accountant, you will enjoy every Diwali. You will be so rich. So keeping that in mind, for a short while, Tejate Sukham. Tejate means sacrifice. Okay, this is my humble submission to you. I know I am, this is not a good advice to a group of youngsters like you, but still, as a teacher, this is my best advice. Of course, I wish you Diwali from a different angle. Diwali is the festival of light. Let the light of learning be glowing in each and every one of you. Let each and every one of you become a light for other people to learn from you. In that spirit, I wish you all a very, very happy Diwali 2023 and looking forward to meeting you again, inshallah, on 14th of November. Bye. Good night.